Okay, here we are, folks. Welcome. Hope you had a great weekend. I sure did. It was too bad it was a little chilly, but we had a taste of Glen Ellen out here. That's where I live. And it was kind of cold and icky for a couple of days. But we got a nice Sunday. Not just a little chilly on Saturday. Hope you guys had a great weekend too. What we're going to do today is packet number 3. For those of you, let's jump back to our quizzes. I saw that a couple of you took the quiz. And let's see. Joanne, did you take the quiz already? Yes, and so did Dan. I'd like to ask Dan, that I saw that you took it 2 times, but you're allowed to do this first time. You could take it 2 times. And so, Joanne, you could go back and take it a second time if you want, but you changed one of your answers, Dan, to the correct answer. It was a calculation problem. And I'm wondering how you ever got that answer. Because I sure didn't. In other words, what I'm saying is that I believe that whoever set up the quiz indicated that C was the correct answer on this one problem, and it should be B. So I'm going to double check with Dorothy and make sure it gets verified.
Tom, was that on question number 6?
Yes, it was.
Okay, yeah, because I did get 2.917, and then I did it in N mode to see what I got, and that would have given me a 2.97, which also would have been wrong according to this.
Mm-hmm.
But you say B is the correct answer?
Yeah, B is the correct answer.
Okay, so you leave it in begin mode, right?
Oh, no. You're in the N mode.
Oh, you're in the N mode.
Yeah,
okay, that's right. I redid it at begin mode.
You know, but you showed C as your second attempt. And I'm going
my first attempt was B.
Okay. And your second attempt was C?
Well, that's because they gave you the answer.
Yeah, okay. And so you just went with their answer. I understand how you did that. All right, so bottom line, folks, it is B. And Joanne, you should have gotten it correct on yours because you answered B also. So I will get it changed. When you look at the answer, but if you really look, I guess you could scroll down and hit check the answer type thing. It did say B in the answer, so someone just hit the C by accident.
Where can you scroll down to check the answer?
Right underneath it. Oh,
you can? I didn't know that.
Yeah, me neither until I clicked on this one spot. Right below the answer, there's a spot where it says verify or take a look at something. And you can click on it, it'll give you the actual answer plus some feedback. All right. So be it. Here we go. Packet number 3. We're going to spend 2 days on this, Monday and Wednesday. I believe we're going to need both days, but we'll see. I mean, you guys I might get through it all today. I doubt it. But we'll give it a shot. So let's go ahead and get it rolling here. All right, first one of the day. All right, some of the slides, it seems like it repeats a few things that might have been said on a past slide. The first bullet point up here about the combination of current income, interest and dividends generated plus capital appreciation. What is that? That's total return. But returns would be a combination. I guess the statement is the way the author put it together. What kind of returns you get? Well, you take a look at, did you get any dividends or interest? Did you get any capital gain? And you come up with an answer. Yeah, I got this as a total return for the year or whatever time period you're looking at. Right below the specific parts here on the expected return, again, is what an investor thinks they will earn. It's the anticipated flow of income and or cap appreciation. Okay, so that's the incentive for accepting the risk, is that expected return. Hey, the required return is what they need to earn. That was, hey, I want to get this type of return. That's the client's required rate of return type of a feeling. And what did they actually get is the realized return. So we saw that last week. It says 5 ways to calculate that. And if you look into your packet of, or your spiral notebook that has all these 10 different sets of slides and all that, and you look at packet number 5, slide number 17-1, it'll refer to these 5 different ways, and we will get that. When we get into that particular class, we will do and make sure you can solve for the arithmetic return, holding period return, geometric time weighted, and the internal rate of return. And that's what that's referring to. All right, so besides return, we have risk. Now, here's between this particular slide here and the next slide on page 2-1 and 2-2. All right, so let's go back to this 2-1 slide. Sometimes people say, hey, can you define what risk is? You know, risk sometimes refers to the uncertainty that the actual return that the investor realizes will differ from the expected return. Okay, I've never used that definition with the client. You know, I usually talk about, hey, risk, how do you like to sleep at night? You know, what can you stomach? How much do you feel that if the market was going down and you were in the market, how much could you lose without getting crazy? I mean, you can say it whatever way you want, but make sure you understand the client's, of course, concerns about risk and how much they can absorb and stomach. All right, but what you have to do, and you've got to make sure you memorize these things, would be the total risk is made up of the systematic risk and unsystematic risk. Make sure you can define systematic risk. It's, you know, those are factors that affect the returns on all comparable type of investments. If you look at what they're referring to in the systematic risk, I'm going to jump down to the slide 2-2, systematic risk, PRIME. Okay. You know, let's see how I want to say this. This risk up here, sources of risk. If we wrote it as in the following method, okay, where we, give me a second to get my knuckles. There we go. Okay, the source of risk is broken down into 2 parts. You got the systematic risk, and you've got the unsystematic risk. This systematic risk that they're referring to, factors that affect the returns of all comparable investments. If you take a look at interest rate risk as an example, when interest rates go up, existing bonds will go down in value. Interest rate goes up, bond values go down. And it does not matter whether you're a corporate bond, a government bond, or a municipal bond. It will still have an impact of going the opposite direction of interest rates. All right, so you've got a bond. If it's a long-term bond, it'll go down more than an intermediate bond. If you have a short-term bond, it'll go down less than the intermediate bond, less than the long-term bond. But the bottom line is you cannot escape what happens when interest rates go up and you own current bonds. And like I said, it doesn't matter if you're in high quality, low quality, government, corporate, or munis, long-term, intermediate, or short-term, you get hit with it. So that's why if we go back to the previous page, or the top of your slide 2-1, systematic risk, capital faces these 5 risks wherever placed. It impacts comparable type investments. You cannot diversify away from it. You can minimize it. You cannot necessarily minimize it, but you can manage it. So in other words, if you had a portfolio of bonds, if you don't have all long-term bonds, and you have some, you know, like 1/3 long-term, 1-term intermediate, 1-term short-term, you know, then interest rates go up. You'll get a blend of how that causes those bonds to go down in value. But if they're all long-term, you'd take a bigger hit. So you can manage that risk by how well you've got it diversified. Make sure you remember that the risk for systematic is measured by beta. Beta measures systematic risk. Unsystematic risk is measured by standard deviation. Excuse me. Sorry. Didn't mean to say it that way. Total risk, which is, as I mentioned to you on this on that slide here, the sources of risk, I used to refer to it as total risk. Total risk is made up of systematic and unsystematic. Total risk is measured by standard deviation. Systematic risk is measured by beta. There is no measurement for unsystematic risk. And so let's go back to that previous slide here. Unsystematic risk, define it. It's that type of risk that is more specific to a particular type of security, something specific to security, something specific to the industry that that particular company is in, versus system-wide risks. This is system-wide risks up here. Systems, comparable investments, the big picture, the macro look. Systematic is the macro look of risk. Unsystematic is the micro look at risk. It looks at it more specifically. You can diversify unsystematic risk, because if you diversify and you put together securities within a particular category that are uncorrelated, that are not highly correlated, they have low correlation, you are minimizing the risk. You are bringing the risk down. Okay, there is no specific measurement for unsystematic. So let's go to that next slide and repeat it again. And I want to keep harping on this because you have to make sure you can watch for a test question. And if they talk about non-diversifiable risk, are they referring to systematic risk or unsystematic risk? Non-diversifiable is systematic. Diversifiable is unsystematic. So the big D is here. No diversification would be over here. All right, now, you also need to be able to memorize what are the risks that come under each one of these. They've got systematic with the word prime after it. A lot of times I would show, if I had this slide, I would have gone like this and called this systematic. Systematic risk. And then I'd put the letters down here, PRIME, so you could see the word as it spells itself out. So whatever it takes for you to memorize, PRIME, know the 5 risks: purchasing power, reinvestment, interest rate, market, exchange rate risk. Know the definitions of each one of those risks. If you look at your textbook, they do define those particular risks. Okay, purchasing power risk is inflation risk. Reinvestment rate risk. You know, when you get into, when we talk about bonds, we'll talk about reinvestment risk in particular, but the idea of reinvestment risk is, in theory, if you had a bond that pays the interest every 6 months, and you get and you say you've locked in a 6% bond coupon rate at $60 a year on a $1,000 bond, you get $30 every 6 months. So when you take that $30, which would be like getting 3%, what would you do with that money? If you reinvested in a money market and that money market was paying 10 basis points, you've got reinvestment rate risk, don't you? Well, reinvestment rate risk is you don't know what the rate will be when you have to reinvest the item. the interest or the dividend or whatever the case may be. If you had that $30 coupon payment, 6-month payment, and reinvested at a rate that was at 6% or 7%, you'd be happy. Okay, I understand that. But that still is reinvestment rate risk. It's the concept, it's the process, it's the theory, it's the idea behind it. You've got a bond that matures. I'll give you an example. In the early 80s, interest rates were sky high. I can remember municipal bond UITs from Naveen back in 82, 83, right around there at 12%, 13% tax-free being issued. People are getting CDs at 15 and 16%. Tremendously high rates of return. But what did they really keep when the dust settled? Just make let me give you a quick one. If they had a 16% CD, they were in a 50% tax bracket. They had to pay 8% back to Uncle Sam. They kept 8, but inflation was at say 12. So if inflation is at 12 and they kept 8, they're 4 in the hole. Their purchasing power eroded. Now, a couple of years later, in 1986, client comes in and says, I got that 16% CD maturing. It was a 5, and it's at 6%. What a bummer. I said, yeah, but if you were in a 50% tax bracket and a 6% rate, you're keeping 3. Inflation was only 1.5. You're 1.5 to the good. You're better off in 1986 than you were in 1982 or 81 whenever you bought that CD in regards to purchasing power. All right, so purchasing power risk, reinvestment rate risk. They come. Do they go hand in hand? I don't know if they're hand in hand, but can they both impact a particular situation? The answer is sure they could. All right, your job is to understand and memorize these different risks and their definitions. Okay. Back again, let's go back into the early 80s. In the early 80s, the only 2 unsystematic risks we used to draw, it looked like this, was business risk and finance risk. Those were the only 2 that we showed in those back then. We never talked about the unsystematic risks of default risk, credit risk, and things of that nature. But now, you better. You need to know that default risk, first of all, what is default risk? Well, it's if a company can't pay the interest on their bonds, they can default. If they can't pay the principal when it comes due, they can default. If they break one of the covenants, they can default. Okay? Well, that's specific to that particular company. Company A defaults is not impacting all the companies in the United States or worldwide or anything like that. It's just that specific company. It's not impacting the industry per se, right? It's just for that particular company. So it's unique to that company. So unsystematic risk, defined as something specific to an individual company or industry. Who runs the business risk? What is that? Who runs the business? Who's in charge? Who makes the decisions? Credit risk, the ratings, AAA, AA, single A, triple B, that type of stuff. That's your credit risks. A company has call risk. In other words, if you buy a bond from a particular company and it's got a call feature to it, that bond can be called away. Well, that's specific to that company. Maybe the company also issues some bonds that doesn't have a call risk. So again, you can see how unsystematic risks are unique to a particular company or industry. Now, if you look in your textbook on page, let's see, I thought I wrote it down here somewhere. Come on, tell me. Yes, page 133 of your Mayo textbook. Do me a favor. Give me a green check. Do you all have textbooks by now? I hope so. How many of you have a textbook? Give me a green check if you have a textbook. because we are going to use the textbook in class today. So hopefully you got it with you. All right, so most of you got it. Rebecca, well, I got you down as being away here. So, Tom, did you get your textbook yet? Red X if you did not. The X is okay. No, all right. Did you order one? Hopefully. Green check if you ordered one. No? Okay, well, hopefully you got one or you're going to get one, because it's important to get a textbook to make sure you stay on top of what's going on in all the readings. But on page 133 of the textbook, they show a picture. Exhibit 5-1, top of the page, shows that total risk, and then systematic to the left, unsystematic to the right. And look, they just show business and financial, kind of like the old look. All right, but as you can see on the screen, there are an awful lot more risks associated with the unsystematic. It does say it's diversifiable, whereas systematic on the left-hand side says it's none. But notice they got sovereign risk over there on the systematic side. And over here on the screen, political risk, country risk, also known as sovereign risk, is over on the right-hand side. So I guess the key, folks, is that maybe different authors might view risks a certain way. I think we could be very, very, very comfortable with the 5 ones that are showing on the screen. Your prime, those purchasing power, reinvestment, interest, market, and exchange rate risks being macro looking, that if the market goes down, like, like, was it October, or was it 19th? 1987 or whatever it was, they had Black Monday, when the market went down 20% as a whole, and you really couldn't hide. There are very, very, very few stocks that made anything. Most of them lost money on that day. Well, that was emotion. That was market risk. You can't control that. Okay, but sovereign risk, is that something that can impact the whole economy? But I guess here's the point. Sovereign risk could probably be on both sides. So don't lose sleep over it. There's maybe one or two that someone will try to make a point saying, oh, it belongs as a big one, because if the Ukraine blows up, it's going to impact all of Europe and all of the world. Okay, maybe it won't. Maybe it's specific to just what's happening out there in Russia and in that area. So take it for whatever it's worth. You come away with some type of a conclusion on that. Right? But your job is to make sure you can memorize all these risks, know the definitions of these risks, know where they fit, whether they're systematic or unsystematic. Watch for test questions. Make sure you read the test question thoroughly. And you should be all right. All right, let's move on. If you have any questions, please, go ahead and ask. Diversification and risk. The goal of diversification is to reduce risk. Portfolio construction is risk-driven process, not a return-driven process. And I tell you, I bet you, in the past, most people would have thought they're building a portfolio. They're going to diversify, and the intent was, they're going to do well, and they're taking a risk, and they're going to make a lot of money. Well, if it was sold that way, if it was sold with, well, look at the return you get on this growth stock over here, or this growth fund over here, and look at international, if you had some international and, developed countries, and you're going to do well, and then so, okay, you could say what you want to say, but I really believe in my heart that your job should never be selling a portfolio for its potential return. Sell it for the idea of the risk associated with the investments inside that portfolio. Be a risk manager. Build a portfolio that's diversified. Try to minimize as much risk as possible. People are very concerned with making, not losing their money. So watch on how you build your portfolio. So that I think that first bullet point is a good one. The second bullet point in particular, combining securities that are not highly correlated produces a total risk that is less than the risk of the individual components. That's what we're going to strive for. And today we're going to talk about how you can ascertain whether a stock is not as highly correlated by doing some calculations and taking a look at some of the statistics that go into determining correlation and how one security moves in comparison to another one, so on and so forth. Bottom bullet point, people are loss averse. Yeah, most people are. Some investors are risk neutral, some investors are risk takers and risk seeking. But most people are loss averse. They don't like to lose any money if it's possible. So you work that out with your client as you go forward. So we won't belabor the point on that. Measuring risk. Probably the first three bullet points go together in regards to if you look at the way it's put together. Securities that are more volatile have a greater degree of uncertain and unwelcome outcomes. Right? So if it is very volatile, high standard deviation, no one can guarantee any type of return, and in a given year there could be a lot. You could lose a lot of money. You can make a lot of money. It depends on how volatile that particular security is. But the second bullet point says volatility measures the degree or likelihood of an uncertain outcome, and thus volatility represents risk. So the bottom line is take all three together and see if you can come up with a way of talking about risk and volatility. They tell you in the screen is in red. It's the standard deviation measures the total risk. We know that beta measures the systematic risk. In that beta on the individual marketplaces. So the beta of the stock market is 1.0. That's the measurement of the stock market. The S&P 500 index is the beta that people usually refer to when they talk about the market. All right. So if by chance you have a mutual fund that has a 1.2 beta, a 1.2 beta is basically saying that your fund or your security is 20% riskier than the market as a whole. Because 1.0 represents the market, 1.2 is 20% more than that. If I said it was 0.8, which would be it's 80, it will perform at 80% of what the market will do. If the market went up 10% and you had a 0.8, you should only go up 8% because you would multiply that 0.8 times the 10% return in the marketplace, and you should at least get an 8%. So it's not as risky as the market is as a whole. And the underneath beta, those bullet points kind of make that type of a statement. All right, so moving right along, we don't need to. We'll come back on the use of beta and all that type of stuff. Now here, this picture of diversification and risk also can be seen in your textbook, figure number 5-2, which is located on page 138. Same picture, in essence, of what you see in here. So let's kind of break it down here for a second here. What's on the horizontal down here will be the number of securities. Okay, so one security is over here, and and whatever. And let's say it's 10 securities right here and 20 over here, and the more securities goes to your right. Okay, so add your securities goes to the right. All right, the standard deviation, low standard deviation is down here at this point, and the high standard deviation is up here at the top. Okay. So in essence, if you had one security which could have by itself a great return in 1 year, it could have a real lousy return in 1 year. First of all, you don't have a very diversified portfolio if you have just one asset in the portfolio. You're going to live and die by its return and by its volatility. But what they're saying is that if you add more securities going to the right, you will bring down that unsystematic risk by diversifying. So as you're adding these securities, it's bringing down, especially if they're uncorrelated, it's bringing down this unsystematic risk to a point where maybe you've eliminated it. Your goal is to eliminate as much of that unsystematic risk as possible. Okay, but notice that you cannot get rid of this of the systematic risk. That's going to be kind of level throughout, because you can manage it. Remember, I told you can manage systematic risk, but you can't eliminate it. So if you add securities that are not perfectly correlated with the portfolio, within the portfolio, you reduce the total risk. So you might want to write this down. How many securities do you need? I've read a number of different publications, and they say that if you have 10 to 15 securities from different industries, they kind of believe you have a fairly diversified portfolio. If you have 12 to 15 large cap securities from different industries, would be acceptable as a diversified portfolio. If you have 4 to 7 different mutual funds from different funds and different asset classes, they would feel you've got pretty good diversification. If you go to the small and the mid cap, they say 25 to 30 securities. Mid or small cap securities would be a diversified portfolio, especially if they're from different industries. All right, so you might say, well, okay, where did you come up with these thinking numbers? Different things you read, that's all. So how many different securities do you need? Okay, well, again, 10 to 15. Some people say a diversified portfolio sit around 15. You're fine. In mutual funds, if you have a mutual fund that has 50 securities inside of it, but they're all large cap and they're all, in one, if they're a sector type fund, which means it's primarily from one different industry, is that diversified? Usually they want you to have diversification across different industries and things of that nature. So conceptually, you have to kind of come to some way of viewing how do you diversify a portfolio. How about not necessarily just stocks and securities? How about diversification through having equities and bonds and real estate, some type of real estate assets, and some of those tangibles, those non-traditional? That's diversification also. So I've seen test questions from different sources out there that would talk about how many securities you need to diversify a portfolio, and I think it's common sense. You can't have just 1 or 2 securities in your portfolio. You got to have a number of them. The key is make sure they're diversified across different categories and things of that nature in industries. Enough of that one. All right, now we're going to get into practicing some calculations here. Hopefully you've got your calculator with you. What do you need to know about the measuring risk with standard deviation? First of all, the top 2 lines, standard deviation measures the amount of dispersion around an expected outcome. Some people will define standard deviation that it measures the variability of the returns. So standard deviation is a variability measurement, whereas beta is a volatility measurement. Beta measures volatility. Standard deviation measures variability. This last couple lines here, where it says it depends on each asset's variability, each asset's weight in the portfolio, and the covariance between the assets, I really believe is the definition for the standard deviation of a portfolio. The standard deviation of a portfolio. Now, where did I come up with that? Let's take a look. this particular slide. Don't worry about it, we'll find it. This is the standard deviation of a portfolio formula. And if we go back to that statement that was on that particular slide, they're talking about the weight. I'll read it. I'm looking at 4-2. It says it depends on each asset's variability. All right, if it's each asset's variability, they're talking about the standard deviation. That's your variability. Okay. It's talking about each asset's weight in the portfolio. There's your weight. Comes up a couple different times in the formula. And then it talks about and the covariance between the assets. And that's that part right there. So when they refer to that definition here on 4-2, I think maybe the top two lines would be appropriate. It measures the dispersion around the mean type of thing. Okay, the other part is more for the standard deviation of the portfolio. All right, now take a look at the formula itself. Does anybody here in class have a copy of the formulas that the CFPEC board has made or will include on your exam? In other words, they said that they will provide to you a formula sheet for investments. Does anybody have one of those? Nobody? I'm going to ask Dorothy to send you one if you don't have it. And I'm referring to on that particular formula sheet will have this looking formula here, formula number 6 on the formula sheet. And this formula here is for the sample population. Sample population versus the formula that will show up on that particular sheet that's for the full population. And what makes this the sample population formula is this denominator, n-1. If it was the full population, it would just have the letter n there, not n-1. Okay? All right, enough said on that. Don't worry about it. When we get the formula sheet, I'll have one that we could, maybe she could load it into the slides for us so we could always refer back to that formula sheet. All right, but here's the bottom line on the standard deviation. There's a long method of learning how to calculate it, and then there's the short method. I'm going to show you the long method so you can appreciate the short method. But the reason why you need to know about the long method is you need to know what's the idea behind it, what's the process, what are they trying to look for. The 6 steps that are shown here, where you find the average, then you subtract the return of the individual securities, for that particular investment or whatever it is from the average, and you square all the differences, add them all up, divide by the number of outcomes minus 1, then you find the square root. That's your 6-step process. Do you need to have it memorized? You could. It's up to you. I would make sure that I understood that the 5th step here is where you get your variance. The answer that comes in on the 5th step is the variance number. And we're going to talk about variance, covariance, and semivariance in a little bit. All right, so going back on this particular formula here, there's 6 steps. Okay, and just let's see, I'm going to erase what I just put on here, clear this page. And give me a second to recreate something here. See this number 1 here where it says find the average of all the outcomes of the mean? That's this part right here. Number 1 is just that's an X with a line above it. I know that the line is kind of sunken in there a little bit, but there's a line above that X. That means that's the mean. Step number 2, where it says subtract the average from each individual income. Okay, you take that average and you subtract it from each individual outcome that they'll give you in the problem. And then step number 3 is just right here where it says squaring it. That's your third step. This was your second step. And your fourth step is taking the sum. Fifth step is dividing it by n minus 1. And your sixth step is solving for the standard deviation by taking the square root. So that's kind of how that formula breaks itself down. So let's go to the next page for a second and see the example that that's put on these particular slides. All right, so it says here, let's measuring risk with standard deviation. It's to say, let's take a look at a situation where someone's driving to work 10 straight days. It takes them how much time each one of those days, come up with the average. So the first step is find the average. All right, now, you all know how to get the average here. You add them all together and divide by the number of parts. Okay, so what would that be if you added all these together going down? That's 2. That would be 200 minutes, and you divide it by the 10 days, and that's how they came up with the 20 minutes. Does anybody know the shortcut to getting that? Have you ever learned how to do this with your calculator and the Sigma plus button? Here, so let me give you the shortcut method on how to get this average here. Turn on your calculator, get your Hewlett-Packard 10B, turn on your calculator, clear everything off. Your screen should have 4 zeros to the right of the decimal point. Are you ready to go? All I want you to do is take these minutes and input them into your calculator and hit the Sigma plus button. And in the HP10B2, my Sigma plus button is in the 4th column, 3rd row, and it looks like a sideways M with a plus, right next to my arrow button. Okay, so if I take 20 Sigma plus, my window shows a number 1 in it. If I take 18, hit the Sigma plus button, my window shows a number 2, because that's just saying, hey, that's your second input. Go on all the way down, 24 Sigma plus, 20 Sigma plus. Just keep doing that, all the way until you get down to the 10th one. Everybody go ahead and do that. And when you got it all in there, here's what I want you to do. I want you to give me a green check that you got them all in there. And your window should show you a 10 on it, which means you got 10 inputs. All right, so we got 2 we got in there so far. Come on, everybody hustle a little bit. All right, good job, Joanne. Are you working on that one? And Valerie, waiting on Valerie and Joanne. All right, Joanne's okay. And Valerie, are you all right? Okay. All right, so we got all those in. What I want you to do is hit your gold button and your number 7 button. Does it come up with the number 20? First, I'll clear it, and you all tell me. If you hit your gold 7, does it come up with a 20? Green check says it does. Okay, you all got it. That's great. Now, that X with the line above it means, underneath the 7 button, just means you got the average. Now you might say, well, what is that X with the line above it, comma, Y with the line above it, comma? with, you know, why do they have X and a Y there? We're not going to do this in class, but you could take two sets of numbers, and if you learn how to input it by using your input buttons and all that type of stuff, you could put in two sets of data and be able to solve for the average of each one separately, and then the standard deviation for each one separately, so on and so forth. But we're only going to worry about inputting that one set of data at this point. All right, so you got gold 7 and you got the 20. How about hitting gold 8? If you hit gold 8, tell me what you come up with. Somebody, either at the microphone or type it in down there. What do you come up with if you do gold 8? Yeah, and you know, that's your standard deviation for those numbers. All right, Heather's got it. And the 8, if you look underneath the 8 button, okay, if you look underneath that 8 button, it has an S with an X, comma, S with a Y. So again, I'm going to say, let's forget the S with the Y. S with a sample population. If you hit your gold and 9 button, you will come up with a smaller number. Okay, once you come up with, or Heather, what do you guys come up with if you hit the gold 9? .6833, all right? And that's because you're using full population. So what that means is, if we go back to this previous slide here, instead of using an n-1, they just use the n. So they divided by a larger number. That's what happened there. Okay? All right. And the symbol underneath the 9 is a symbol for standard deviation. That symbol, that little circle with the tail above shooting out the top, is a symbol for standard deviation. All right. So you just went through the quick method of solving for standard deviation. But let's move on and take a look at this next slide here, which is on 5-2. And let's go through those 6 steps. Okay? All right, if you have your microphone on, you got to turn it off, because I'm getting some feedback over here. All right. Remember I mentioned to you there were 6 steps associated with the formula? You're going to be able to see those 6 steps take place right here. Here's step number 1. You found the average. That was 20. Step number 2 would take each one of those times subtracted from the 20. As you're taking the actual outcome, the first year was 20 minutes minus 20, so it's a 0. 18, you made it faster than the second day, so that's a -2, so on and so forth. All right. Third step says what? Take those answers and square them. Okay, that's your third step. So they squared 0 times 0 is 0, -2 times -2 is a 4. So as you can see, squaring positive numbers or negative numbers will always give you a positive number at the end here. Fourth step, add up all these numbers. And now you're coming up with the sum. All right? They show it right here, 72. So all these numbers were added up, came up with 72. Fifth step, divide the total numbers by the outcome -1, that's your n-1, and you come up with the answer of 8. 8, remember I mentioned to you the step number 5 gives you your variance number. Variance. It's an absolute number. What does it mean to you? Not a whole heck of a lot. That's for sure. It doesn't mean a whole lot to me. Just a number 8, and it's the variance number. Well, they say, okay, we'll take it one step further. Let's put it in some way that you could explain it to somebody. And step number 6 says, well, find the square root of that particular number. So the square root of 8 is 2.8284, which we did the FAST method using the shortcut method. And the shortcut method is located on top of 6-1. where I said to you, use that sigma plus key. So as you can see, the 20 sigma plus, 18 sigma plus, all the way through, and then you hit your gold number 8 button, or gold 7 to get the average, gold 8 to get your sample population. So if you didn't have a chance to write it down, it's right here on the slide. It's that shortcut method. Okay, so then you might say, okay, well, what's all this stuff about? What am I going to do with the standard deviation? All right, we'll go to this next slide here. How to apply standard deviation. Okay, this is slide number 6-2. All right. What you're looking at right now is the normal bell-shaped curve. You all remember that from way back when you were in high school and maybe in college. I don't remember seeing this in college. I can remember it from high school. But what's it supposed to represent for you? Okay, a way of explaining standard deviation. Right down here in the middle is your average, 20. And then if you add, and let's take our 2.8284 standard deviation from the previous slide, 2.8284, and we'll make it into a round number of 3. And we're going to take that 3 and we're going to add it to the right and subtract it from the going to the left, and realize that this one standard deviation occurs 68% of the time. Okay, and that's what the bullet point right below it, approximately 68% of the time. See that? Outcomes will fall within the range of one standard deviation to the left and right of the average. So returns should fall somewhere between 17 and 23. In this example, it was minutes, but let's assume those were percentages. Same idea. Okay. Now, there's only 3 standard deviations that you can use. So let's go ahead and move it out a little bit for the second standard deviation. All you do is add 3 more to the previous standard deviation and subtract 3 going to the left. And you got to remember that 2 standard deviations occurs 95% of the time. And let's take it 1 more standard deviation to the right and left, out to the 29 and back here to the 11. And remember that it occurs 99% of the time. All right, what you have to definitely remember is if we have the average, which is in the middle, going to the right is 50% of the time, going to the left is 50% of the times. We use 3 standard deviations, which takes you 99% of the time left and right, which means that outside of this is 0.5% on both sides. Okay, so your job is to remember that standard deviation is a dispersion around the mean. You get the mean by adding them all up and divided by the number of parts. And then you discuss that the variability around that mean is that you could explain to your client, well, you know what, if we get this investment with these returns here, 99% of the time, you're going to get a return somewhere between 11 and 29%. That should occur around 99% of the time. But there is always that outlying particular year or point in time where you get a return less than 11, or you can get a return greater than 29. But statistically speaking, 99% of the time, you're going to get a positive return. People like to hear those types of statements made. More specifically, 68%, 2 out of every 3, 68 is like 2/3, right? 2/3 of the time, you're going to get a return somewhere between 17 and 23%. Oh man, those are great investments. Give me a couple of them. All right, so the key is understand normal bell-shaped curves, understand standard deviation. Whatever, if you add one to the right, you have to take that same number off to going to the left. Know the percentages, and then be able to understand the probability of certain things occurring. Let's look at underneath at the bottom of this particular page. As is with lower volatilities, like for instance T-bills, have taller and thinner bells since their outcomes are captured in a narrow band and they cannot have returns less than 0. Okay, T-bills usually don't lose any money. Sometimes they don't make a whole lot of money, and we're not talking about paying the taxes and subtracting the inflation rate from it and finding out that you're below 0. You don't go that far when you're making that type of a statement. It just that you don't lose money, but you got to talk about, is there ever such thing as a riskless investment? People say, oh, T-bill is a riskless, is a risk-free investment. There's risk in everything, and the risk on a T-bill would be purchasing power risk, if anything. All right. So you got to get this picture. You got to get a feeling for what it's all about. So one of the things that they might do to you is take a look at what's on this next page here, next slide, which is on 7-1. It says that if an asset has an average return of 11 and a standard deviation of 5.5, what is the probability percentage that an investor would lose money on that investment in any given year? All right. So if you're not comfortable with standard deviation, you got to become comfortable, because you have to understand. Let's go through the numbers and understand these statistics. Okay, so let's draw a quick line here. Okay, let's come up with the average. And what do they say the average was here? 11%. Okay, so you got the 11%. Right here on the bottom. Standard deviation of 5.5, so you go 5.5 this way and 5.5 that way. Okay, so if you subtract 5.5, you're sitting at 5.5 to the left. Add 5.5, you're at 16.5. Going to the right, that's one standard. Let's go another standard deviation, subtract another 5.5, and you're finally going to be at 0. Right here, 0. Right? Because you got to subtract another 5.5, so add another 5.5 to the right, and we're at 22. Alright, so 68% time we know is one standard deviation. 95% of the time is two standard deviations. So what is the answer that you should give me? What is the probability percentage that an investor would lose money in any given year? Anybody have an answer? You could type it in, or you could take the microphone and tell me. And the answer is 2.5%. Very good. And how do we get to 2.5%? Well, remember, if this is 95%, between two standard deviations, leaves you 2.5 on this side and 2.5 on that side. And the question is the possibility of losing money, so dropping below 0 had to be 2.5, and that answer shows up on the bottom of the slide 7-2. But the point is, can you visualize that and can you interpret it? Actual comp exam had a question on there that asked you to interpret probability of returns based on standard deviation percentages, and they give you something somewhere on this particular line, or they use some type of an expression where they're talking about, 68% of the time, 95, 99. What percentage could be all, if they said what would be the percentage probability that you'll make money? Making money would be what? If 2.5% is on the left side going backwards, we're going to say that 97.5% going forward is the probability that you're going to have some type of a positive return. So it all depends how they're going to come at you with the type of question. But they do ask you to understand standard deviation as a measurement of variability. One of the things you might catch on an exam would be the following. I'm going to go back on a slide here. If they told you that your standard deviation was 2.8284, could you determine what the variance number would be? Well, first of all, you have to know the variance number is the number right before you saw for the standard deviation. And the way you got your standard deviation is you took the square root of that variance, right? So now all you got to do is square this number. Right? If you square the number, you should get 8. All right? So you can work either way. Make sure you can do that. All right? And that you understand the idea behind that. Now, what I'd like you to do is we're going to skip a couple of pages. And I want you to go to 9-2 and look at this particular slide. Now, if you have your textbook, I want you to turn to page 190 of your textbook. I got my book here. I'm taking a look at page 190. And what we'll do is we'll take a break after we get done, for 5 minutes after we get done with this particular page, okay? And on page 1, they talk about skewed distributions. Okay, and on these skewed distributions, they give you 3 different sets of numbers, 3 sets of data, column A, column B, column C, gave you different returns that occurred, and they told you that the average for each one of those particular sets of data was 11.5. But one of them would be a normal looking distribution, whereas the other ones are skewed. Okay? And what you need to do when you're looking at that particular book, and on the top of page 191, figure 5A.3, they have those particular pictures of how it would look. Okay? All right, so let me take a whiteboard approach here, since not everybody has a textbook. And let's see if we can reproduce this real fast here. Okay, so if we put the average right down here in the middle, like I said, the average was always about 11.5 on A, B, and C there. And this is the data from A, B, and C. You know, the normal shape puts it right in the middle. But on B, they're saying that the distribution is skewed to the right. And when you talk about distribution being skewed to the right, the majority of the returns occurred early. And notice that the the average is over to the right a little bit. Okay, a lot of the returns occurring over in this particular area, right over here. And you can see on page 190, if the average was 11.5, that 6, 7, 8, 9, and 10, those 5 different sets of of numbers there are to the left of the average, and that there was one that was sitting way out here on the right-hand side, 29, that brought the average up, but many of them were to the left of the average, and so they would say that the data skewed to the right has a positive skewness. Okay, whereas on C, many of the returns are to the right. Okay, with and we look at it that there was one way over here, a number 3 return, 3% return here, that brought the average to the left, and all the rest of them, 12s and 13s and 14s and 15s, were on this right-hand side. So they said that it was the data was skewed to the left and it has a negative skewness to it. Okay. Now you might say, okay, well, what the heck am I going to do with this type of stuff? Will I ever show this type of skewness type of a book to my clients? And the answer is never. Now, I have never done it in 30-some years. But I believe what they're trying to say to you is that not everything is perfect out there, that returns are not necessarily equally distributed to the left and the right of the average. You don't have a normal bell-shaped curve most of the time. You have curves that have some type of skewness to it. And since the CFP board said that they wanted to make sure you knew that they used the word kurtosis and skewness as subtopics that you had to learn about. Okay? Now, when they talk about this thing, kurtosis, and all the stuff I'm talking about right now is located on page 190, 91, 92, 192. Okay, so you want to read up on it, because you hate to lose a question because of not knowing about skewness and kurtosis. And all they're saying on this kurtosis thing, let me give you a picture here. Just a second. Okay, on the kurtosis, let's get the average in the middle. Is that a lot of times returns will hover close to the average and be kind of in a peak, they call it peaked, okay, versus those that are rounded. Okay, so the degree to which a bell curve is pointed or rounded at the top, if they said that it had high kurtosis, it means it is peaked at the mean. And they say, well, it's peaked at the mean in fat tails. Okay, so I guess this is considered a fat tail out here. These are fat tails going out left and right. Don't know much about the fat tails, where that expression came from. Low kurtosis means it doesn't peak and it's rounded more toward the top. So if they said it had higher kurtosis, it means that more of the variance is due to infrequent extreme deviations. That would make sense. High kurtosis, peaked kurtosis, more of the returns are closer to the mean, not a lot of variance then, and it's very infrequent variances. People who said, I'd like to have my returns kind of set and kind of consistent within a range. Well, then you want something that has high kurtosis. Whereas if it's rounded, it's the returns are all over the place, left and right. Okay. Okay, so kurtosis measures the what is relative to a normal curve, I guess. All right, enough of that stuff. Again, what are you going to do with it? I've never used it, but I think you just have to interpret. I guess if they had a question and said, and you're looking at this particular security or the fund, and its returns are skewed, have a positive skewness to it. Positive skewness. So you might have to say to yourself, okay, if it's positively skewed, go back to this page. More of the returns are to the left of the mean of the average over here. And there's some outlying, returns that kind of brought the average up a little higher. Most of the returns are below the average. That's how I would kind of interpret what they're trying to say there, if they say they're positively skewed. All right. So let's go ahead and take a 5-minute break. I got 6:41. I'll start talking at 6:46. And we're going to pick up on covariance and correlation coefficients and things of that nature. So make sure you come back in 5 minutes. Turn off the recorder right now. Back together here. All right, how about a green check? That I know that some of you are back here, ready to roll. And I got 2, anybody else 3. Looking for anybody else. Val, Dan, 10. All right, Dan's back. Val's back. All right, Dan's the only one. All right, let's take a look at this screen one more time, 9.2. Let me kind of just add a few points, okay? Start at the top, the normal distribution. Classic bell curve distribution of data. A normal distribution has a balanced, symmetric look to it, okay? Normal distribution, a balanced, symmetric look to it. Log normal, defined relative to the normal, to the normal distribution. It says, hey, there's going to be multi-factor variables that are going to impact the type of balance, and cause. So a log normal distribution is always asymmetric or skewed. A log normal distribution is not balanced. Normal is balanced. Log normal is not balanced. It's skewed. So a normal distribution can be used when discussing investment returns because returns can be positive or negative. A log normal distribution is more appropriate when discussing stock prices because asset prices can never go below 0. But returns can go below 0. So when would someone use this log normal distribution? I guess if they're looking at stock prices, all right? Now, if normal distribution, the average is okay to use. That makes sense. You remember how you look at the normal bell-shaped curve and then average right in the middle, and there's to the left and the right, you can kind of determine the 68% standard deviation for one standard deviation, 95 for 2, 99 for 3. Average is okay to use because average is a measure of central tendency. Now, skewed, they say that the average is not good to use. Skewed, the average is not good to use. So here in this A, B, and C, the skewness that occurred right here, okay, you don't want to use, the average is not good to use. So what is good to use then? Okay, well maybe the alternative measure of central tendency is the median, which splits the distribution into two halves. Okay, so let me backtrack. Skewed, average is not a good one to use because it's offset. Many of the returns, if it's positive skewed, are to the left of the average. So average would be a poor measure of central tendency. They say then go to the median, and the median is where you take and split the distributions in half, where half are to the left and half are to the right. So that's just kind of hopefully brought it together a little bit more. Okay, let's take a look at the back here on this skewness part. It says it measures the lack of symmetry in a bell curve. Okay, we already know that. They say skewness is for a normal distribution is 0. Okay, so if skewness for a normal distribution is 0, then data that is skewed left will be below, and you're going to have a negative number associated with it. But, and I don't know what number would be, a good number, bad number, or whatever, but just be aware that if the normal distribution is considered 0 in regards to how they depict skewness, negative skewness to the left would be below 0. Skewness to the right has positive skewness, which is a positive number above the 0. Kurtosis, they say, normal distribution is a 3.0. So the low kurtosis, which is that rounded one, would be lower than 3. High kurtosis, which is the peak kind, will be above 3. Again, I don't think they're going to worry whether or not people know about those particular numbers. I think it's just the perspective of normal, symmetric returns, log normal. Balance is not to take place. It's skewed one way or the other. Know what positive means, know what the negative skewness means. All right. Moving along. Weighted. No, I don't want to do weighted average. I gotta go the other way. Covariance. What is covariance? First of all, make sure you can memorize covariance measures the degree to which the price movement of one security is related mathematically to the price movement of a second security. In other words, you can explain it's a strength of relationship. You look at covariance and you can make a statement that I could interpret or determine that 80% of the movement of security A is determined by the movement, can be determined by the movement of security B. So covariance measures the degree to which the price movement of one security is related mathematically, can be explained away by the price movement of a second security or a benchmark. And usually a benchmark is the one that most people will use it up against. Covariance is a raw score with no boundaries. So you might say, where are we going with this? First of all, when you get your formula sheet, this will be the third formula on the formula sheet. If you take your Mayo textbook and go to page 184, they did a nice job in your textbook of giving you an example of what this is all about. Better yet, before we jump over to 184, go to 179. So for those of you who say, gee, I got to practice a little bit more about the standard deviation, if you look at the Appendix 5 in your textbook, Statistical Tools, they give you the standard deviation. They give you two different securities, A and B, on page 179. and they tell you that you could go ahead and solve for the average and then this for A and B, and then you eventually solve for its standard deviation, so on and so forth. And you notice the formula that they show you there is the same formula that was on your sheet from before. Okay, when you turn to page 180, they take you through the steps up in the top left-hand corner there, and then they show you in the example about stock A, and they go through the average return and subtract the individual returns, find the difference, square them, add them together. They go through all the steps. So your 6 steps are shown there. Even though they show you 5 at the top of the page, it's because they combined one of the steps together. All right. Just remember, variance comes before the square root. All right. So now, if you would jump over a couple of pages, we're going to come back to semivariance. On page 184 is covariation and correlation. And if you take a look at that particular page 184, they give you two returns, Fund A and Fund B. 5 years worth of returns. They added them up together and told you that Fund A has a 10% average and Fund B has a 12% average. And respectively, the standard deviations for them are 2.449 and 8.426. Do me a favor, okay? If you would, I would like you to go ahead and do the shortcut method and come up with that. So what I'm going to do is give, because some people might not have their textbook with them, let's go ahead and give you the stats, and you're going to have to kind of do it yourself. Okay, so we got year 1, 2, 3, 4, and 5. Security A had a return of 10%, 14%, 8%, 8%, and 10%. And security B, same year. First year had a 17, then they had a 3, then they had a 16, 21, and a 3. So what I asked you to do is do the shortcut method, do your sigma plus buttons, and tell me, did you come up with the average for this one was 10%? If you did, give me a green check. Just erase the green checks. I want you to give me a green check. All right, so if you did do it the sigma plus method and you came up with the 10, then I know that if you hit the gold 8 button, you should come up with 2.449. And then if you do the same thing on security B and use your sigma plus button, 17 sigma plus, 3 sigma plus, 16 sigma plus, 21 sigma plus, you should have come up with 12% is the average. If you came up with 12% as the average and you use your sigma plus buttons, then I know that if you go to gold 8, you'll come up with the standard deviation of 8.426. Everybody get those? So practice makes perfect, no doubt about it. But what I want you to see on the top of page 185 is how they developed covariance. All right, so here's the bottom line. If you look at what they did is they broke it down. If you draw a line in between after the third column and between the third and fourth column going up and down. Okay, so what I'm going to do is kind of fictitiously draw this line right over here. All right, they took on security A the 10 and subtracted it from the average being 10, and you had a difference of a 0. So I'm just going to go ahead and put the 0 here. That was 10 minus 10 is 0. And then the 10 minus the 14, the actual return is 14, the average was 10. So this was a negative 4. And then the 10 and the 8 would be a 2, and 10 and the 8 is a 2, and then you get a 0. And then over on the B one, if the average was 12 and you had a 17% return, the difference was a negative 5. And then you had a 9. 12 minus the 3 is a 9. And then 12 minus the 16 would be a negative 4. You had a negative 9. 21 minus the 12 minus the 21 is a negative 9. And then a 9. All right, so where did they come up with covariance? All they said for covariance was that they wanted you to take those differences and multiply them times each other. So 0 times a negative 5 was a 0. A negative 4 times a 9 is a negative 36. The 2 times the negative 4 was a negative 8. The 2 times the negative 9 is a negative 18. And 0 times 9 is 0. Add those up together, you come up with a negative 62. And then, if you take your formula, which you don't have the formula sheet in front of you, but the formula is shown right there on page 185, and they said, hey, if you want to solve for the covariance of acid A and acid B, you take the sum of those differences, which is a negative 62, and divide it by number of parts minus 1, which would be 5 parts because there's 5 years worth of return, minus 1, which would be a 4, and then 62 divided by 4 is a negative 15.5. All right, so we just solved for the covariance number. Covariance number is a negative 15.5. So what the heck does that mean to you? First of all, it's an absolute number. This negative 15.5 is just an absolute number by itself. The size of the number, the larger the number, the more variance there'll be. The lower the number, the less amount of variance there will be. But from an eyeball standpoint, I would say because of the negative sign that these two securities are negatively correlated. These two securities are negatively correlated. So you might say, what do you mean by negatively correlated? That means that they move in the opposite direction of each other. All right, so wait, let's take that a step further here. For stock A, remember the average for stock A? Well, let me do something here. Let me get a. Remember the average for A was 10%. I'll put the 10 right here by each one. Okay. So now I want you to tell me about the relationship of what took place in the first year. Well, if the average was 10 and they did a 10, then it was, it was kind of equal to each other, right? I mean, it did not outperform, it didn't underperform, it just was, the return was equal to its average. But in the second year, it outperformed the average. In the third year, it underperformed the average. Fourth year, it underperformed because the average was 10 and it only did 8. Still had a positive return, but it underperformed it. And in the fifth year, it was equal to its average. Now compare that to what took place over here on the right side with security B. Same time period. And remember, on security B, we had a, let's go this way here. Let's see, we had a 12 average that took place. So what happened in the first year? In the first year, it outperformed. Second year, it underperformed against its average. Third year, it outperformed. Fourth year, it outperformed. Fifth year, it underperformed up against its own average. But now they're saying on covariances, how did it move in the same year compared to each other? Okay, well, A had it performed equal to its average, and B was higher. Okay, so they didn't perform equally. Year number 2, one went up and the other one went down. Okay, so they moved a little bit opposite each other, not equally opposite each other, but they moved opposite. So A outperformed against its own average, and in relationship outperformed versus B, which underperformed. But over in the third year, B outperformed versus A, outperformed against its own average, and then outperformed what A did. In the fourth year, B outperformed. In the fifth year, you would say that A did not outperform against its average, but it did outperform what went on with B. So they kind of moved opposite of each other, not equally, but somewhat. That negative point, that negative 15.5, because it came out to a negative sign, you could have said that they are negatively correlated with each other. So you might say, okay, well, what are we going to do with that? Well, let's get a new page up here and talk about correlation coefficient as an example. My correlation coefficient, we draw this line here, find the midpoint here. Let's label this properly. Okay, over here on the right-hand side, if we had a 1.0 correlation, that would be to the right. If we had a negative 1.0, so the range on correlation coefficient goes from a positive 1.0 to a negative 1.0. And right here in the middle would be a 0 correlation. And if we take the information that we had on security A and B and look at page 185 at the bottom, they said, well, you know what, if you take that covariance, well, first of all, correlation coefficient is described as a capital R. So capital R with an AB here for acid A and against acid B is equal to the covariance, which was a negative 15.5. And you divide it by the standard deviation of acid A times the standard deviation of acid B. And we already said that the standard deviation of acid A was 2.449, and the standard deviation of B, which you did from your calculation before, was 8.246. Multiply those together, divide it into 15.5, and you come up with that this correlation coefficient ends up being a negative 0.75. Actually 0.7511. Okay? So if I take that 0.7511, put it on this particular graphs chart, depiction of correlation coefficient. Put it right about here. You call it a negative 0.75. I could see that based on correlation coefficient is negatively correlated, pretty highly negative correlated because of the 0.75 correlation there, and that they do move opposite of each other. Not all the time. Now you might say, wait, let's go back to the all the time, not all the time. If I had the S&P 500 index going up 10%, and I had my money in the Vanguard 500 index fund, I would say that my Vanguard 500 index would move basically in tandem with whatever happened in the S&P 500 index, and in performing equal to, the only difference would be that maybe my Vanguard fund would be just a little bit lower than the actual return of the S&P 500 index because of the expense ratio of the Vanguard 500 index fund. A very small expense ratio, but it should not outperform. So the Vanguard 500 index fund probably has a 1.0 correlation coefficient, or if anything, a 0.99, positive 0.99 correlation coefficient with the index, or with the whatever we're putting up against. This one here, these two securities had a negative correlation. Now you might say, well, can you tell me what percentage of the movement of A can be described or explained by the movement of B? Well, if this is correlation coefficient is equal to a negative 0.75, R squared, also known as the coefficient of determination, which is another one of those terms that's on that page. You take your negative 0.75 and multiply it times a negative 0.75, and you come up with a 0.5625. 0.5625, which is the systematic movement measurement, which means that if, and let's just get rid of the 25, 56% of the movement can be explained on, A and B, you could explain 56% of the movement by their relationship to each other, which means that 44% of the movement is unsystematic, and 44% of the movement cannot be explained by the movement of the other security or the benchmark or whatever the case may be. So you go back to that original set of numbers, and you can see that they didn't move exactly the same way, but they moved opposite of each other. About 56% of the movement can be explained, A can be explained by the movement of B. The other 44% is exclusive, unique to its own variables. That's what your walk away on this is. SP 500 over here on the right hand side, SP 500 in the Vanguard fund, 0.99. Well, what is 0.99 times 0.99 equal to? 0.99 times 0.99 is 81. Let's do that again. 0.99 times 0.99, 98%. 99% of the movement of one can be explained by the movement of the other, leaving very little to unsystematic movement. So one of the things that when you do your reading, they're going to talk about, can you believe in the beta associated with these particular securities? And if the R squared is not high enough, if they're not highly correlated, and your R squared is below a 0.70, if it's below a 0.70, then you can't use the beta as a good measurement of risk. You would have to go to standard deviation, which takes into account total risk. But if the beta, the correlation, the coefficient of determination is greater than that 0.70, which means it has a high correlation, then you can trust in the beta as being okay as a measurement. All right, so when they get into doing the Sharpe and the Trainer formulas, as an example, let me give you a new page in there. The Sharpe formula reads something like this: the return on the portfolio minus the risk-free rate of return is divided by the standard deviation. The Trainer formula says the return on the portfolio minus the risk-free rate of return is divided by the beta. The Jensen formula, these are all risk-adjusted performance measurements. The Jensen formula says that the alpha is equal to the return on the portfolio minus the CAPM formula. Also written in the following way: the return on the portfolio minus the risk-free rate of return. This is the CAPM formula, which is inside this parentheses here. Risk-free rate of return of the portfolio plus the return on the market minus the risk-free rate of return times the beta. Okay, so if the two securities that are being looked at have a low R squared, low coefficient of determination. Remember, R squared is also called the coefficient of determination. If that is below a 0.70, then you would say, man, I can't rely on beta as a good measurement of risk adjust. So if I can't rely on the beta here or the beta down here, then I need to go to this particular formula here, run the numbers, and then determine which security I like better or which fund I like better, or which one did what it was supposed to do. Okay? So that's why you need to know about covariance, correlation coefficient, the relationship associated with high correlation, high coefficient of determination, and whether or not you could rely on beta as a good measurement. So let's go back to these definitions here and see what it says. Covariance measures the degree to which the price movement of one security is related mathematically to the price movement of a second security or a benchmark. Covariance is a raw score with no boundaries. We already know that. Covariance as a number doesn't mean a whole lot. So you take that number, then the only thing you can come out of that raw score with is it a positive number or is it a negative number? If it's negative, then you could say that they are negatively correlated. If it's positive, you can say they are positively correlated. Okay, now we go to the correlation coefficient. You take your covariance. It says it is the same concept of covariance, but is reduced to the scale of a -1 being perfectly negatively correlated and a +1 being perfectly positively correlated. Okay? And so all I did there is go to this particular picture here. Perfectly negatively correlated is over here. Perfectly positive is over on the right-hand side. So what does perfectly negatively correlated mean? Well, if one security went up 10% the other security went down exactly 10%. Perfectly negatively correlated. One went up 10%, one went down 10%. That's perfectly negatively correlated. Perfectly positively correlated. One goes up 10%, the other one probably goes up just about 10% too, minus any type of an expense ratio or whatever. But that's positively correlated. Well, what if it's got zero, no correlation whatsoever? Then it's just saying to you that the returns have nothing to do with each other. That there's no correlation whatsoever, that you can't explain the movement of one by the movement of the other. They all have their distinct individual variables in strengths and weaknesses that cause it to go up or go down in value. One could be going up 15% and the other one goes up 2%. One could be going down 8% and the other one went up 3%. It doesn't, you can't, there's no rhyme or reason for their movement. So your goal in working with your client is to move, if you have two securities that are highly correlated and you want to reduce the risk, you want to be moving in this direction to your left down the line, trying to get no correlation or negative correlation. Ideally, getting a -1 correlation would be the ideal, but probably pretty much impossible to do unless you're using derivatives to help you get to that point. But you want to have securities that have lower correlation to each other to reduce the risk. That's what your goal is. So page 185 gave us that picture. Showed you about, on the top of the page, the different movements that occurred on security A against its own average and then again up against security B and what took place during that particular year, and vice versa. Security B, how did it do against its own average and against in relationship to what happened with security A at the same time? That's what that is trying to give you. And then they showed you the two different formulas on the bottom of that page, in the middle and at the bottom, on how to solve for correlation coefficient, how to solve for covariance. Okay? That's what it's all about, folks. So let's go back to that. So covariance and correlation. So what came first, the chicken or the egg? Did covariance come first or correlation coefficient? The answer is covariance has to come first. You have to be able to come up with the numbers. You get a raw score, it doesn't mean a whole lot other than the fact that it's either positive or negative, and then you could interpret from that, but then you don't know to what degree, and that's when you change that raw score into a correlation coefficient number. And then last but not least, this R squared is the correlation coefficient squared. Indicates what percentage one asset's movement is determined or caused by the movement of the second asset. Okay, what does it say? This concept is used most often to explain what portion of a mutual fund's return, good or bad, is caused by the movement of the overall market, while the balance of the return is caused by the individual security selection. Okay, see this R here? R squared, it's just squaring it, that's all. All right, so that's that particular part of risk measurement. How about coefficient of variation? Now, where does that come in? All this stuff, coefficient of variation, and what are we supposed to measure by that? All right, first of all, coefficient of variation, if you look at page 182, go back a page or two, 182, it starts to talk about this coefficient of variation. About start of the third paragraph. Coefficient of variation. All right, let's see what it says on the screen. Measures the risk taken per each unit of expected return Measures the risk taken per each unit of expected return. Risk divided by return, so a low number is desirable. In other words, you don't want to have as much risk per unit of return. You'd like to have less risk per unit of return. Now here, I want you to think about this. Remember when I showed you that formula, the Sharpe formula? Okay, Sharpe formula was the return on the portfolio minus the risk-free rate of return, and you divide it by the standard deviation. It's a risk-adjusted measurement. Amount of return per unit of risk. In the numerator is the return. In the numerator is the return. In the denominator is the risk. So when since you're dividing one by the other, it ends up being a type of a ratio. You want a higher return per unit of risk. So you would like to see a higher number here. Coefficient of variation is the risk divided by the average return. Okay? The amount of risk taken per unit of return. You would like a lower number. Make sure you know that. Same with the trainer. Trainer. Return on the portfolio minus risk-free divided by beta. Amount of return in the numerator per unit of risk, the risk being the beta. On Sharpe, it's the total return, the total risk. On trainer, it's a systematic risk, a beta. You want a higher return on trainer. Coefficient of variation. You want a lower number here because you don't want to take as much risk per unit of return. That's your takeaway. You got to make sure you know that type of stuff. So let's go back somewhere. Come on. Slides. There you go. Coefficient of variation. Measures the risk taken per each unit of expected return. If the average return between the two assets being compared are equal, okay, so if you have the assets, if you're looking at two different assets out there, and the average returns are pretty much equal to each other, then just look at the standard deviation, and you'll say, hey, the one with the lower standard deviation is not as risky as the one with the higher standard deviation. But if the returns are different, then you need to find some other mechanism, some other way of determining which one of them would have on a per unit basis would be able to show you which one is more efficient or not as risky. Okay? So let's give an example here. We have two securities, security X and the security Y. Okay, so the average return for X is 12%, and the average return for Y is 20%. The standard deviation for X is 9%, and the standard deviation for Y is 10%. Okay, which one is riskier? So you say, gee, well, we got to see. We don't have the same averages. Is it the one with the higher standard deviation or whatever? It's all it's all a relationship. It's a ratio. So you take this coefficient of variation calculation, take your standard deviation of 9% divided by the 12%, and you come up, this is the 9%, so that would be a 0.09 and a 0.12, and you come up with a answer of 0.75. you do it for the other one, and you take your standard deviation of a 0.1 divided by a 0.2, and you come up with a 0.50. You want the lower number. Y offers lower risk per unit of return, or another way of saying it the other way is a superior return per unit of risk. That's the coefficient of variation. You need to know how to solve for it, know how to interpret it. All right, let's go to the next page, 9-1. All right, beta. We already kind of talked a little bit about beta earlier. Measures systematic risk only. Okay, measures systematic risk only. It's a relationship between an asset standard deviation, the market standard deviation, and the correlation coefficient. Okay, what are we talking about here? Okay, there is a formula. First of all, on your formula sheet, that will read something like this. Beta is equal to, come on, there we go. Beta is equal to the standard deviation. Okay, come on, pen work here. The standard deviation of the individual security divided by the standard deviation of the market, the benchmark, times the correlation coefficient of that individual security to the market. That's the formula for beta. The standard deviation of the individual security divided by the standard deviation of the market times the correlation coefficient. So let's go back to the previous page and see if that's what it says here. It's a relationship between the asset standard deviation, the market standard deviation, and the correlation coefficient between the asset and the market. So you run the numbers and you'll come up with, remember, the beta of the market is 1, and you run these numbers, and they say that you come up with a 1.2, you will say that the individual security is 20% more volatile than the market as a whole. Okay, that's the interpretation of that. If it's a 0.8, it's 20% less market volatility compared to the market as a whole. All right, so that's the formula for beta. I never, for years, I always thought beta was associated with stocks. But you know what? There's beta in bonds. You might say, wait a minute, I've never heard of beta in bonds, and I never did either until I saw a question once. But, you can have a standard deviation of a return on a bond, right? That could be that. You could take the bond market and look at the standard deviation of the bond market. And then you could look at the correlation coefficient of the security of the bond to the market. Run the numbers. So if the market has a 1.0 and the beta of the calculation on the bonds was a 1.4, you're going to say that the bond is 40% greater, is 40% more volatile than the market as a whole. If the beta was a 0.9, market went up 10, yours would only go up 9. So it's 10 percentage points lower in regards to volatility, in market volatility. Where does one get the market beta? It's a given. I think on that, Joanne, they always say that the basis of beta for the markets will always be 1.0. So if they say that a benchmark that is used to describe the market, like the S&P 500, is we got the Dow Jones, that's a benchmark. The S&P 500 is a benchmark. The Russell 2000 is a benchmark. All different ways of interpreting, what the markets are in general. So the S&P 500 is a good indicator of the market as a whole, and the SP 500 represents about 80% of what the market does, supposedly. And they say that's a pretty good indicator. Okay, so if you say, okay, then that index will be given a 1.0 data point, and then you calculate everything else around it to determine is the fund that's compared to it equal to it, has the same standard deviation of it. Is the fund that you're looking at have a higher standard deviation or a lower standard deviation? So that's how it's kind of put together. Okay, market standard deviation. Remember what standard deviation is. So they look at the year 2000 and look at the various returns of the securities that are included in the index, and solve for the standard deviation using the old Sigma Plus button. You know, they might have 500 inputs, and then they come up with an average, and they come up with a standard deviation, right? And then they'll do the same thing for the year 2001 and 2002, and all the years going forward. They'll be able to just go ahead and determine the standard deviation by just looking at the various returns of the underlying securities inside of the market or inside of the index. That's how they do that. Okay, moving right along here. Let's go to semivariance. Wait a minute, we just did covariance, we did correlation coefficient, we know about variance. Well, what the heck is semivariance? Semivariance is a risk measurement similar to the standard deviation, but it only measures the outcomes that were below the average and excludes those outcomes above the average. Okay, I'd like to just add a point right here. It's not necessarily, I mean, they could ask you to solve for the semivariance and not necessarily use the average. They could say, how about below zero, returns that are below zero in that, you know, for the time period that you're looking at, or below a target number, or below the index number. So it's not necessarily below the average. It could be below the average, yes. It could be below zero. You could say use it below target number, use it below the index. Is there one better than the other? The answer is I don't think so. I think it's just a matter of being consistent. All right, so where do you get this calculation? Go over to 182 of your textbook, and they give you, on 183, two different investments. So let's go ahead and do that real quickly. And so we got, on page 183, you got 5 different periods of time. 1, 2, 3, 4, and 5. They got security A, which had a -7 return the first year, had a -5 the second year, a 6 in the third year, an 8 in the fourth year, and a 13 in the fifth year. Security B, same period of time, had a 0 return, a -2 return, a -7 return, an 11% return, and a 13% return. And I'm going to ask you to do the following for me. Would you please calculate the average return, the variance, and the standard deviation for each one of these securities? I want you to solve for the average return, the standard deviation, and the variance. So what was the average return for A? give you a second here. Okay, correct. Now this is 3. All right. So if you know that the average return is 3, what was the standard deviation for security A? .63. Okay. And did you do the sigma plus method, Heather? Okay. So let's kind of round it just to make it 8.6, make it a little bit simpler. All right. So now if we know the standard deviation, we can come up with the variance, can't we? All you do is square the standard deviation, and you come up with right around 74.5. If the standard deviation was 8.6, then the variance had to be about 74.5. Now let's do the same thing for security B. What's the average for B? 3. What's the standard deviation for B? 8.6. So what the heck's the variance then? Well, if it's 8.6, it's got to be 74.5. So you're saying, holy moly, wait. Looking at both of those securities up here, A and B, can we come back and say which is more volatile than the other one? They got the same averages, same standard deviation, same variances. So how can you determine that one is more volatile than the other? Well, in the following way. If you look at the bottom of page 183, it takes you through it. And so what are we going to do? We're going to say, let's take and calculate anything that was below 0 or below. Okay, so we're going to just take these two guys here for A, and these 3 here for 0 or below for B. And kind of go through the same technique we did before in regards to finding the differences. Okay, so if -7 was the individual return and 3 was the average, the difference is a -10. If 5 minus 3 gives you -8, square those numbers, and you come up with, for security A, you come up with 100 and a 64, and together you get 164. Now let's go ahead and do security B. If we take security B and take 0 minus the average of 3, which is a -3, and then square that, you come up with a 9. -2 minus a 3, and you come up with a -5, and square that. -2, -3, and you get a -5, right? For that one. And you square that, it's a 25. And the -7 and the -3, -7 minus a -3, or -3 the average, you get a -10. -10 squared is 100. Add those two together, and you come up with 134. And you stop right there. And you say, hey, the higher number is more volatile. So the sum of the square difference is largely for investment A. It suggests that it's riskier than security B. All they did on the semi-variance calculation was take those particular numbers that were below 0 or less up against its average, squared the numbers, add them together, and found the higher number. The higher number is more risky than the other one. Here we got two securities, A and B, both with the same average, both the same standard deviation, both with the same variance, of course, and we were able to dig a little bit deeper to determine that A was a little bit more volatile than B. That's what semi-variance brings to the table. So let's go back to the semi-variance is a risk measurement similar to standard deviation, but it only measures the outcomes that were below something, the average, like I said, a target rate, 0, a benchmark, whatever. The theory is that the investors are more concerned about the instances where they underperform the average, and then they go through some other explanations here. So your job is to make sure that you, number one, understand the concept behind what is semi-variance supposed to give to you. What is coefficient and variation supposed to portray? What is, whatever your answer is, how do you interpret it? So is there a process for calculating all this stuff? Yes. Will they ask you to calculate for it? The answer is maybe. What do you mean maybe? Give me a yes or no. Will they ask you to calculate it? Well, the formula for covariance is on the formula sheet. So you tell me, if they gave you the formula, will they ask you to solve for it? I don't know. They used to have on the formula sheet also this formula for correlation coefficient, but they took that one off the formula sheet because they figured, okay, if you know covariance, you could interpret how to get the correlation coefficient. It's just using your algebra. Well, wait a minute. How are you supposed to know how to use your algebra? And then they'll say, wait a minute, you got a college education. You graduated high school. You graduated in college. You got brains. You were supposed to learn that stuff. All right, you might say, well, wait, practically, I use a computer. I don't, all right, then they might say, all right, we might not ask you to do the calculation, but we might ask you to interpret the idea behind it, what it's supposed to represent, what's the process, that type of stuff. So you take it as far as you want to go. You take it as deep as you want to go. Will you ever have to calculate these things? The answer is maybe, maybe not. So I take you through it once. You look at the book. You can read all about it. It gives you explanations of it. It gives you a practice problem on it. Shows you how it works. You take it and interpret it whatever way you want. All right, moving right along. We got about 13 minutes left in class. If you would take a look at this weighted average return, well, this is pretty simple stuff. It says suppose an investor had two asset portfolios, one got a 50% return, the other one got a 10%, and then they're saying to you, well, wait, the return on the portfolio right here, this return on the portfolio, let's change the color here so we can pick up on it. The return on the portfolio of A and B would be dependent upon the percentage of the portfolio was invested in, what percentage of the portfolio was invested in each one of the assets is going to determine what's your return on the portfolio. Whatever we're doing for weighted average return, you can do for a weighted average beta return too. So we'll take a look at the process. Let's go to the next page and I'll give you an example. Okay, so they're just saying that we don't have to use our calculator. It's right here on the board. But if you had a 50-50 split, half your money was in portfolio A and half was in portfolio B. All right, well, if half of portfolio A got a 0.5 return, excuse me, backtrack. If half your portfolio, which is 0.5, that's your weighting right here, got a 50% return, would be equal to getting 25% on that portion of it. The other half of your portfolio that got 10%, you would have earned 5. Add the two together, and you come up with a 30% return because that was split 50-50 between the two securities. But what if you had if you were smart and you said, man, I knew how to pick a man, and I put 80% of my money in that one particular security, and that 80% that you put in the security earned 50%. Well, what's 80% of 50% is 40. The other 20% only earned 10, which is still a nice return, of course, right? Well, if 2% of your portfolio earned 10%, then it was 2% of the total return. Add the two together, you got a 42. So you got a 42% return because you put more of your money in the bigger return. That worked out. But what if you flipped it over and you said, hey, my equity position is 20%. Oh yeah, sure, it got 50% return, and I only got 20% of my money in there, so I really reaped the benefit of 10% on that 20% of my money. But the 80% being in a more conservative type investment got a 10% return, so I get 8 on that one. So I get a total of 18%. So that's how, weighting, how much money was in it proportionally, and what was the return, and you come up with a weighted return. If I said, hey, let's do a weighted beta, you would have gone with the idea of just substituting the beta in place of the average return. Okay, we'll do one of those problems before we leave today with the beta. So there's two ways of handling it. One way of doing this previous one here was you had to know the percentage of the weighting and multiply it times return. They said, well, if you take your calculator using the Hewlett Packard 10B, you could use the following method. This is the implication is we're weighting the average. So remember, whenever you do this type of a calculation using the input button and the single plus buttons, whatever you're going to weight goes in first. So you're weighting the average returns. So you're putting the return here. So it's 50%. Hit your input button, and then hit your dollar value. 80% of your money, in theory, was in there. Sigma plus. Input your 10% weighted return. Hit your input button. 20% of your value was in there. Hit your Sigma plus. Solve by going to your gold button and then your number 6 button, because on your number 6 button, underneath your 6 button, they have an X with a line and a W, and that represents weighted return. Okay, okay, let me look at this question that's down here. Why did investment only have 2 periods? Investment B, 3 periods on page. Oh, okay. Who's asking that question? That was Heather. Heather, let me go back to this page 182 or 183 and 184 of your textbook there. And the reason on the semi-variance and why we went with 2 periods versus 3, because the question was, let's take all the returns that were either 0 or below. So in A, only 2 of those years was it below either 0 or below 0. In investment B, 3 of them were below either 0 or below 0. That's why you went from 2 periods and 3 periods, because the client says, hey, I'm concerned with the fact that the losses that occurred in my portfolio, and here my friend has a portfolio over there, and they only lost 2 years, and they lost 2 years plus 0 in 1 year, so they did better than I did, but wait a minute. And I said, but I'll go back and say, no, you didn't. You both had an average return of 3. You both had the same standard deviation, and the bottom line is, was whose security was riskier than the other. And when you crunch the numbers, you determine that A was riskier because of the magnitude of the losses compared to their averages. You know, in the big mix of the whole thing. So it's just a way of measuring, and semi-variance says pick a number. You know, you could just say, hey, anything below 0. If we said just below 0, and 0 wasn't included in there, we would come up with the same conclusion, because the -2 and the -7, when you square them versus against the average, is going to have a lower number, even lower than what A had to begin with. So that's the idea behind that. All right, looking at the screen up here, 6 minutes to go, and we're just about done with what we're going to cover for today. So you make a decision. Do you want to go with the method here or this method over here, you know, as to coming up with a way to return? It's up to you and how you want to handle it. So all this one here that you're seeing on the screen right now was that version of what was in the middle here on the 80-20 split. So you might say to yourself, well, is there any method to the madness? I mean, where are we going to go with it? What's it supposed to kind of develop? So let me give you a scenario, and you make the decision on how you want to do it. What if you had this as a portfolio to look at, right? Portfolio. You have 3 different investments in the portfolio, A, B, and C. A had $150,000 in it. B had $50,000 in it. And C had $75,000 in it. And the return on A was 15%. B was 20%. C was 10%. And the beta for A was 1.0. B is 1.13, and C was 0.72. And I might say to you that I would like to know, first of all, what is the weighted average return for this portfolio, and what is the weighted beta for this portfolio? What's the weighted average return for this portfolio, and what's the beta for this portfolio? So you guys go ahead and work on that. And you could do it 2 different methods. Which method do you want to go? Using the signal plus button and the input button, or finding the weight. So taking it, here's the thought pattern behind this. If you're going to go the longer, the one method is you got to find out what does the total portfolio add up to, and it adds up to $275,000. Then you have to take that $275,000 and find out, well, what is $150,000 proportionately in the portfolio? Well, if 150,000 and this one is 200, and the whole portfolio is 275,000, then you say that security A makes up 0.5455, carrying out 4 zeros, 4 places to the right for security A. Security B is the 50K divided by the 275K. Just kind of bringing the numbers down a little bit. And that makes up 0.1818 of the portfolio. And C is 75K. Look at how long it's taken me to get this, folks. 75K divided by the 275, which means this makes up about 27.27% of the portfolio, because when you add up all these percentages, it better equal 100%, right? Now take that 0.5455 times your 15, take this 0.1818 times your 20, and then take the 0.2727 times the 10, and come up with the weighted return. And your weighted return would be how much? Ends up being an answer of 14.55% when you run all your numbers. If you did the weighted beta, taking that percentage times the beta, you come up with a weighted beta of 0.947. So it's up to you on how you want to work it. Could you have done it that other method? What do I mean by that other method? Well, the method that goes, take the whatever you're weighting, put in first. So I'll take that 15 return, hit my input button, and put 150. I don't have to put the 150,000 there because it's all proportionate. Get rid of all those zeros, and hit my sigma plus button, and then take by 20. And if I didn't want to put the 0.20, I could, still going to be proportionate. Just use the number 20 as a whole number, 20, and put in the 50, and hit my sigma plus button. And then take the 10, whatever you're weighting, remember, it goes in first, and then weighting returns, and hit the 75 sigma plus, and gold 6, and then come up with the answer. And if I wanted to do it over here for the beta, I would just put in the 1, input it, 150K sigma plus. Put in the 1.13. Hit the input button, 50,000 sigma plus. Put in the 0.72. Hit your input button, 75 sigma plus, and hit your G6, gold 6, and you come up with the answer. I don't care how you get there. You make the decision. So if you're doing a weighted average return, you got to find out that, there's 4 steps to it, right? What are the 4 steps associated with this top one here? One is find out the total portfolio. Number 2, find out each individual percentage of one. Number 3, multiply that times whatever you're weighting. And number 4, add them all together. Over here, whatever you're weighting, put in first, hit your input button, and the dollar value, or whatever it is, sigma plus. So it's up to you which way you want to go to get to the weighting process. And I might say, okay, well, why do I need to know this? Because when we do the standard deviation of portfolio, you need to do that. And then also, what if they would have said to you, and I'll finish in about 2 minutes, what if they would have said to you, well, look, you got this existing portfolio, A, B, with these 3 securities, A, B, and C. I would like to change what's in security B, sell what's in security B, buy security D, which had this type of return and this type of a beta, will I be able to keep the same amount of return and reduce my risk? Well, the only way you could ever determine by, should you sell B, buy D, input that data into this whole portfolio, determine what that weighted return would be in that weighted beta, and compare it up against the original weighted return and weighted beta. That's an actual test question where they take you and say, okay, sure, you might know how to weight things, but now let's use it. That's what that's all about. So you got to get yourself comfortable with this because you don't know which way they're going to come at you. Having said that, here's what I want to tell you about. See this one here? Let me clear this page here. What I'd like you to do is solve, as your homework assignment for Wednesday, is here's your formula, here's your different pieces of data, solve for the standard deviation of the portfolio using this data. We've talked about every one of these topics: covariance, coefficient of variation, expected returns. We know how to weight. Run the numbers. All right. We will start at this point on Wednesday. As you can see, I'm going to go through these slides real fast. Then we're going to hit modern portfolio theory. Talk about the indifference curves, optimal performance. There's your capital asset pricing model. We'll discuss that. Here's your sharp training Johnson. Kind of introduced that already a little bit. And find the key points of these particular risk-adjusted measurements. We already talked about beta, but we'll introduce alpha. Why should you do risk-adjusted returns? And there's some reasons. Introduce you to the information ratio, which was a newer formula that was put on the formula sheet a couple years ago. It wasn't there a while back. Take you through one of these questions as to what you would do. Hit the arbitrage pricing theory, which this particular formula that's down here, right here in the fourth bullet point. Okay, this was on the formula sheet at one time and was taken off. I'm talking about this formula down here. But we'll still have to explain what goes on in a multi-factor asset pricing model. Review what a scattergram is all about. Talk a little bit about this quantitative analysis. And we're done. Whew. So we got a lot to cover on Wednesday. But you had to get some of the basics out of the way. So keep doing your reading and work on the standard deviation of the portfolio, and we'll move from that. So we will put in a good 2.5 hours on Wednesday to complete assignment number 3. And then you'll have a quiz that you'll have to do. So for those of you who haven't done your first quiz, get that out of the way. And then make sure you stay up on top of your reading. Anybody have any questions, comments, or concerns? It keeps coming at you, folks. Any questions? None? Then we'll see you on Wednesday. You have a great day. Great night.